Hello class, this is Dr. Fenton. In this video, we are going to talk about stockholders' equity. And as you already know, this will be the lower section of the right side of the balance sheet. So let's get started. Now, invested capital is what you'll see in the stockholders' equity section. And this represents the money that the owners put in at the beginning of the business to get it started. It also includes any profits left over into the business. If you remember from earlier chapter, we talked about corporations, and there are such things as called articles of incorporation. These are sometimes called the corporate charter. This is the document that shows the nature of the firm's activities, the shares of stock to be issued, that's the amount of shares that they can issue, the maximum number they can issue, and also the initial board of directors. I'm not sure if you've seen an organization chart yet. Here's one. And the stockholders, of course, are the owners of the corporation. The stockholders will vote on and elect the board of directors. And then the board of directors will be overseeing the corporation on not quite a daily basis, but they should meet quite often. For the larger corporations, they'll probably meet once a month. Smaller corporations, probably less frequent. The board will then select the CEO, Chief Executive Officer, or the President, interchangeable terms. And then that person is responsible for hiring all the other people that you see. Vice President for Management, other Vice Presidents throughout, the CFO, Legal Counsel, and so forth. When a person is starting a business and then grows the business and then takes it public, there are several steps that usually happen. You can see down here that the founders of the business, they have an idea and they start small. They put in their own money. They might borrow more money there in step 2 from friends and family and so forth. So they're growing the business, it's getting larger. Then they might seek money, to help grow the business even larger from angel investors or capital venture companies. Now, an angel investor would be like those people you see on Shark Tank, wealthy individuals, and they look for bargains. I shouldn't say bargains. They're looking for a good business idea, has a great future. They're willing to put some money into it, but they want a certain percentage. Now, the amount of percentage they receive depends on the agreement the owners work out with these angel investors. On Shark Tank, they'll be looking for usually minimum 10%, sometimes a little bit lower, but then you'll see them sometimes ask for 20, 25, 30%, and I've seen them ask for even 50% or more, and sometimes they try to buy the entire company. So those are angel investors, individuals who have a lot of money and they're willing to invest in a business for a return of part ownership in that business. Venture capital firms will be these companies that accumulate a lot of money and they go around looking for companies to purchase or to invest in. Now, the first time a company or a corporation issues stock to the public is called the initial public offering. In other words, IPO. Taking a company public through an IPO is a major deal. It requires a lot of people. You have the attorneys involved, the underwriters involved, public accountants involved. So there's a lot of background work going on. Major investment bankers such as Citigroup, Morgan Stanley, and so forth, they might charge up to 6% of the issue proceeds for their services. So it's very, very costly. So that's why it takes a while to build a business and get it to the point where it's ready to go public. Now, publicly held corporations are traded on the New York Stock Exchange or the NASDAQ. And these are the common companies you've heard about: Walmart, Exxon, and so forth, Apple, Microsoft, Intel. They all have been taken public. You can become an owner in any of these companies today if you want to. Go out and buy some stock. And all these companies are regulated by the Securities and Exchange Commission, the SEC. Privately held companies do not allow investment by the general public, and they have a lot fewer shareholders usually. Some of these are Cargill, Mars, Food and Candy, and so forth. So you'd be surprised that some companies you've heard about are still in private ownership. Stockholder rights. Now, when a corporation is formed, then whether it's public or private, the shareholders are the owners of the corporation. The corporation is now a separate legal entity. It issues the shares of stock to these stockholders in exchange for cash or other assets. What they have then is the right to vote, and this means electing the board of directors. They have the right to receive dividends if dividends are going to be paid. Now, dividends do not have to be paid. You have to wait until the corporation is in good financial condition to be able to have the cash and have the previous earnings to issue dividends. If the corporation happens to be dissolved or whatever, then the shareholders have the right to receive some of the assets after all the creditors are paid. So stockholders have certain rights. Corporations, the advantages will be limited liability. That means that the owners are limited in their personal liability exposure. It doesn't mean the corporation cannot be sued. So the corporation as a business doesn't have limited liability, but the owners do. Also, there is an easier ability to raise capital and transfer ownership. Want to sell your corporation? Just sell the shares of stock. Now, corporations will have some disadvantages. There are additional taxes. There's a separate layer of taxes for what I will term as regular corporations. In tax terms, these are C corporations. So you have a level of tax at the corporate level, and then when the dividends, the prior profits are distributed to the shareholders, that same money might be taxed again. So you have 2 levels of tax, sometimes 3 levels. If you have one corporation paying dividends to another corporation that owns the stock, and then later that corporation pays dividends to individuals. So taxes are a disadvantage. There's more paperwork. There's more paperwork to get started, more paperwork to keep up with. You have to report requirements on the company to various governmental agencies. You have shareholders meetings that have to be held and so forth. So a lot more paperwork involved. And then there is what's called an S corporation. And this is a valid corporation, just like any other corporation, limited liability for the owners, but it's treated as a partnership. What that means is that there's only one layer of taxation. So there's a tax benefit to having an S corporation. All of your major corporations traded on the stock exchange, those are C corporations. S corporations would be for smaller corporations, and the number of shareholders are limited to only 100 and fewer. There are things such as LLCs, and LLCs are limited liability companies. Some people use the incorrect term on the last word. They think this is limited liability corporation, but it's not. It's a company. So it's a non-incorporated business. And there are limited liability partnerships as well. Okay, next page. Let's talk about common stock. This is the basic stock ownership that must be sold first. We'll get into another kind of stock in just a minute, but this is the basic form of ownership. So the common stockholders are the true owners of the business. When a corporation is formed, then in the paperwork it shows the maximum number of shares that it can sell. Those are the authorized number of shares. Now the corporation usually doesn't sell all those, but there is a maximum number that it can sell. Now the shares that are sold are called issued stock. So once the shares are sold by the corporation to shareholders, those have been issued. Now 2 other terms, the number of outstanding stock shares, that'll be the number of shares held by investors. And you think, well, isn't the number of issued stock the same as outstanding stock? In many cases, yes. In many cases, no. Why? Because we could have something called treasury stock. Treasury stock is where the corporation itself buys back from the shareholders some of the shares that were previously issued. So let's say you might issue 100 shares. Later on, the corporation might buy back, let's say, 10 of those shares. That means there are 10 shares of treasury stock and only 90 shares of outstanding stock. So issued stock are the ones that have been sold. That'd be, like in my example, 100 shares. Outstanding stock, 90. If the corporation buys back another 10 shares, let's say. Here's a little graph showing the same thing. Definitions. Now par value. Par value is the legal capital per share that's assigned when the corporation is first established. The second sentence right here, this right here, I do not agree with this. It says par value originally indicated the real value of the company's shares of stock. I don't think that's true. Okay, that's enough said of that. Par value is just a dollar amount or a penny amount that's just set by the corporation when it first gets started. Facebook, look at Facebook for instance. Back in 2015 it was trading above $100 per share. Its par value is this is far less than a penny. So that's why I just don't think that second sentence is true. So don't worry about it. The thing you need to know here is that par value does not equal market value. The market value is what the stock is selling for on the stock market. Par value is that amount in the corporation's documents that just states this is the par value. That's all it means. It's just a par value used for accounting. We'll see that in just a minute. Some states don't require par value, and so you could have no par stock and it just doesn't have a par value. Okay. So let's account for some stock issuances here. So in this first example, we have a corporation that issued 1,000 shares of no par stock, and they sold the stock for $30 per share. And we saw this back in chapter 2, I believe. So 1,000 shares times 30, that's debit cash coming in the door to the corporation, $30,000. Then answer the question, why did this cash come in the door? Because the corporation sold common stock, $30,000. So when the corporation sells its shares to the public, this is the entry. Now let's throw in here a par value. So start off the same, 1,000 shares will be sold, and they're going to be sold for $30 per share. Now if the par value, which again is not market value, but if the par value is a penny, here's the entry. We still have cash coming in at $30,000, debit cash 30. And here's what you need to know when you have par value or even stated value. Take the number of shares times the par value. Here's only $10. 1,000 times a penny, $10. And then the difference, $29,990, is in this new account called additional paid-in capital. It's called exactly what it is. Paid-in capital is what the shareholders have paid into the corporation, which includes this account, additional paid-in capital, and common stock. So the thing is here, how much cash did the corporation receive? There's your debit. What's the par value of the shares being sold? That's one of the credits. What's the difference? Just subtract. Use this account, additional paid-in capital. As I said a minute ago, stated value is another word for par value. Preferred stock. Now, preferred stock is a different class of stock compared to common stock. The reason it's called preferred because it is preferred as to dividends. So if dividends are going to be declared and paid by the board of directors, the preferred stockholders get their dividends first, and then the common stockholders may receive some of the dividends. Also, the preferred, if the corporation is dissolved, then the preferred stockholders will receive the assets before the common stockholders will. There's various features. They can be convertible. If you do have convertible preferred stock, then those shares can, at some point, be converted into common stock. This is the option of the shareholder, so if the shareholder wants to keep the preferred stock, then they don't have to convert. Now, redeemable. Sometimes this features here, and they can return this to the corporation for a fixed price and receive cash back from the corporation. This is usually at the option of the corporation. It might redeem, in other words, buy back the stock at a fixed price. Cumulative means that if in any one year dividends are not paid, that amount will build up year after year that they're not being paid, and then finally, when the dividends are paid, then the preferred stockholders will receive all that past missed dividend amount first, then the current year dividends, then the common stockholders will receive their dividends. So with cumulative, any missed prior dividends, prior years, that will be caught up first before the common stockholders will receive any dividends. Now, the preferred stockholders usually do not have voting rights. There might be certain issues in the corporate charter that say that preferred stockholders can vote on this issue, like maybe some kind of major event in the corporation, maybe major expansion, or maybe accumulating a lot of debt or something. But usually preferred stockholders don't have voting rights. Common stockholders do. They don't have as much risk as common stockholders. And then they're sort of in the middle here when you compare to bonds. Bonds will be debt. So bonds, the corporation must pay the interest. So you got to pay the interest, got to pay the bonds back, and that takes precedence over paying dividends to the preferred stockholders or to the common stockholders. Here is an entry. We have 1,000 shares of $30 par value preferred stock. It's being sold for $40 per share. So at 1,000 shares times 40, $40,000 is coming in the door. Just like common stock, take your number of shares times par value, but make sure you use the preferred stock account. It's a separate account from the common stock. So 1,000 times 30, $30,000 credit, and the difference goes into additional paid-in capital. That same account we used earlier, $10,000 in this case. Here's a sample balance sheet. In the stockholders' equity section, always list preferred stock first. And so just state the details: $30 par value, 100,000 shares authorized, 1,000 shares issued and outstanding. So $30,000 is the amount we've placed into the preferred stock account in this entry right here. The common stock, remember, if we have the 1 penny par value, then we have $10 in here. They can issue $1 million, but they've only sold and outstanding right now 1,000, so $10. Additional paid-in capital, those two credits we had adds up to this number, $39.90. Total paid-in capital $70, and then retained earnings that will be those prior earnings retained in the business will be $30,000. So the total stockholders' equity section is $100,000. Let's look at dividends. Now, preferred stock, like we said earlier, if the preferred stock has the feature of being cumulative, then if we miss several years of dividends, then when we finally pay a dividend, we must make up for those previously missed dividends. So in this example, similar to what we just went through, 1,000 shares of 8%. They added the 8. We'll use that in just a second. But 1,000 shares of 8%, $30 par value preferred stock. And also we have outstanding 1,000 shares of $1 common stock. That was the beginning of 2019. Now each year, since the stock is cumulative, we take the number of shares outstanding for preferred stock, not common but preferred, times that 8%, that percent given to us, times the par value. So when you do this, it's $2,400 each year we are, quote, supposed to pay for dividends to the preferred stockholders. We don't have to. If we don't have the cash, don't have to have the earnings, we don't have to pay dividends. But eventually when you pay dividends, you got to catch up on those missed years. So to continue with this example, they say dividends were not declared in 2019 or 2020. And so dividends in arrears, as they call it, the missed dividends in previous years, dividends in arrears for 2 years will be $4,800. So $2,400 each year. We've missed 2 years, so $4,800. Now let's say that in 2021, the company declares a total dividend of $10,000. Now we got to figure out how to divide this $10,000. How is this divided up among the different kinds of shareholders? If it's cumulative, then we come up with the amount in arrears, 48. Then the current year dividends for 2021 for preferred, another 2,400. We need to pay 10,000 out. So add these two numbers up going to the preferred stockholders first. Subtract that from the 10,000. Then we get how much is going to the common stockholders. They receive whatever's left over. So if it's cumulative preferred stock, catch up on the previous missed years, the current year, all that's for the preferred stockholders, then the common stockholders gets whatever's left over. If it's a non-cumulative, if we miss previous year's dividends, we don't catch up on those. So this would be 0 here. You don't even have to write this down here, really. 0. Preferred dividends for 2021, 2,400. Then the rest of it goes to the common stockholders. This would be a lot more since it's non-cumulative. Now, treasury stock. Treasury stock is not a different class of stock. We only have 2 classes of stock, common stock and preferred stock. Treasury stock is just the name given to the stock that the company buys back, and this is its own stock that it buys back. So that's called treasury stock. So it's not a separate class of stock. It's just the corporation buying back its own stock. Now, why do corporations buy their own stock back? It might be to boost underpriced stock. So the supply and demand, fewer shares outstanding, the value of each share goes up then, of the ones outstanding. So they might buy back to boost the stock. They want to distribute surplus cash without paying dividends in this case. They might want to boost earnings per share. We'll talk about that a little bit later. And they want to satisfy some stock ownership plans. In other words, they might say, well, you have to give a certain number of shares of stock to the employees. Then the corporation might buy back treasury stock to give that to the employees. To account for treasury stock, then let's say that the corporation is buying back its own common stock, and if it's going to buy that back at $30 per share, then we will debit treasury stock, a new account, for $3,000, and this is 100 shares times 30, and then it's paying cash to buy these shares back, so $3,000. So there's a simple entry when it buys back its own stock. You don't worry about par value. You did when you issued the stock, not when you buy it back. So debit treasury stock, credit cash for the amount paid. So here is a before and after picture of the stockholders' equity section. We saw this earlier. What has changed? We now have a negative $3,000 over here. Treasury stock, it's a contra stockholders' equity account. So it goes with these other stockholder accounts, stockholders' equity accounts, but you put it in here as a negative number. So we're down to $97,000 in the stockholders' equity amount. Now let's say that the corporation sells some of those shares. I guess we're going to sell all of them. So it resells these treasury stock shares, and it sells them for $35 per share. Okay. So the cash coming in the door will be the number of shares being sold. This is treasury stock shares. 100 times 35, 3,500. Remove, in other words, credit from the treasury stock account, the cost of those shares, 100 times 30, 3,000. The difference is recorded into the additional paid-in capital account. So let's use that same account, additional paid-in capital. This is the entry then when the corporation sells those previously purchased back shares. These are not new shares being issued to the public. These are treasury stock shares the corporation had purchased back and now selling those back out to the public. And then a before and after, selling those shares back out. When you were holding the treasury stock shares, $97,000, sell them back out, this is gone. Back up to 100 with another 500 in this account, so $100,500. Now, for some reason, the value of those shares goes down. Then what you will do, record the the cash coming in, 100 shares times 25. Treasury stock is still credited for the full amount of the cost when you bought those. And you can see we need a debit then to balance the entry. Put that into the additional paid-in capital account. Really, you're taking that out of, you're reducing the additional paid-in capital account because you're reducing some of your paid-in capital. Okay, that's the entries for that. And earned capital, retained earnings. Okay, you know what this is. And retained earnings is equal to all net income since the company began. What you could add into this also would be also less any losses. So if you had a net income one year, net loss one year, net income again, you would net all those out to get this number. And then when you pay dividends out, that causes retained earnings to be reduced. So anytime you see retained earnings in a balance sheet, all prior profit and losses netted out minus previous dividends paid out. That's what retained earnings. In other words, just like the title says, earnings that have been retained in the business. And dividends, cash dividends. Okay, so when a corporation is able to, then it declares and pays a cash dividend. So let's look at some entries down here. The example here is if the corporation has 2,000 shares of common stock outstanding, when the board of directors decides that a dividend can be paid, there are 3 dates. There's the declaration date. That's the date they decide and make public they're going to pay a dividend. It's all public record at that point. There's a record date, and that's where you have to decide whoever owns the stock at the end of that day is going to receive a dividend. Then the 3rd date, a little bit later on, is the payment date. That's when the you can say dividend checks will be dropped in the mail. So 3 dates. They declare it, and they'll say, like in a 2 weeks or a month or whatever, whoever owns the stock at that date, that's the record date, is going to receive the shares, receive the dividends, and then the payment date is later, and when they're paid, drop it in the mail. So 3 dates to keep up with. The example here, we have 2,000 shares outstanding. That's the 1,000 shares of common stock and 1,000 shares preferred stock. Now, if they declare a 25 cents per share on all the shares, both preferred and dividend, then 2,000 shares times 25 cents, $500 total. Debit dividends, credit dividends payable on the declaration date. That becomes a legal liability. When the board declares a dividend, it's a legal liability. So here's the entry you make. Debit a new account dividends, credit dividends payable, $500. Then, when the checks are dropped in the mail, on the payment date, you debit dividends payable to reduce that account to 0 and credit cash because that is the total amount of the dividend checks that you're writing. Okay, so we have 2 entries, one on the declaration date, record the liability, payment date, record the cash being paid. There's no entry on the record date. All right, next page. Stock dividends and stock splits. The only thing you need to know about this is a stock dividend is where the corporation issues more shares of stock to the current stockholders. Maybe the corporation wanted to sort of keep the stockholders happy, give them something, but didn't have enough cash to declare a cash dividend. So you can have a stock dividend. So if there's like a 10% stock dividend and you owned 100 shares, then you would receive 10 more shares of stock. You're not receiving cash here, you're receiving actual shares of stock. Now there's a 100% stock dividend. If you own 100 shares, you'll receive 100 shares. So you own 200. And that's really like a stock split. A stock split is where they'll say like a 2-for-1 stock split, or they might say 3-for-1 stock split. That tells you you're either going to double or triple the number of shares you have ownership of the company. So a 2-for-1 stock split is if you own 100 shares, you'll receive 100 additional shares. A 3-for-1 stock split is if you own 100 shares, you'll receive 200 more shares, and you'll now own 300 shares of that stock. And we're not going to get into the entries for that. Reporting stockholders' equity, we've already seen this. This is an example they pulled out. No preferred stock's been issued. You see the $1 for common stock, but this is in millions of dollars. This is $1 million. Additional paid in capital is over $4 billion, almost $5 billion. Retained earnings, over $6 billion. Treasury stock, quite a bit. $5 billion in treasury stock, that's a lot. That reduces stockholders' equity, and they have other comprehensive loss that we're not going to get into. So total stockholders' equity is $5,762 million. Now, someone might ask, why doesn't stockholders' equity equal the market value of equity? Well, stockholders' equity is in the balance sheet. It's an accounting number. It does not reflect the value of the stock. The market does that. the market value of a corporation equals the stock price times the number of shares outstanding. So you look at the end of the day, see what the stock price is for one of these publicly traded companies. Then if you take that dollar per share amount, multiply it times the number of shares outstanding, that's the market value of that corporation. So it's not the stockholders' equity section. So those are not the same thing. Market value, book value are not the same thing. Book value is just assets minus liabilities, which equals stockholders' equity. But market value and book value are not the same thing. Here's another statement. You can look at that. And you looked at this statement back in Chapter 2, I believe, maybe even Chapter 1. Statement of stockholders' equity. It shows for each stockholders' equity account how it changed during the year. So all these are zero because this is the first year of operations. Then it issued preferred stock during the year, issued common stock, additional paid in capital went up, retained earnings, paid dividends, paid a stock dividend, and then net income, and then treasury stock, bought some, sold some. So your stockholders' equity statement here shows the change in every one of your stockholder equity accounts. And a little review, you can look at this yourself. Okay, next page. Equity analysis. Return on equity, just simply net income divided by average stockholders' equity. Average stockholders' equity is the beginning of the year equity plus end of the year equity divided by 2, simple average. Divide that into net income, and this shows you the ability of management to generate earnings from the resources that have been provided. What is the investment in the company? How well are you using that investment to generate a return? And return means net income. And this is showing comparing Facebook to IBM. Facebook is a 19.8% return on equity. IBM 72.4%, a lot more. Dividend yield. What you want to know is how much in dividends will I probably receive if I buy this stock. So what you're going to do is divide dividends per share by the stock price. So how much did the corporation pay in dividends last year? What's the stock price at the end of the year? That's the dividend yield. And so Facebook is not paying any dividends apparently. IBM is. So IBM has a 3.3% dividend yield. That means if you buy IBM stock, then probably, it's not guaranteed, probably each year, based on these numbers, you will get a 3.3% return on your money through dividends. Again, dividends are not guaranteed, and IBM might decide not to pay any, but this shows you what happened several years ago. Earnings per share, probably the most quoted number in the financial world. What are the earnings per share of a corporation? This will be net income. Take away dividends paid on preferred stock though, because you're trying to find the earnings per share for each share of common stock. So net income minus dividends on preferred stock, get that total number, divide by the average shares of common stock outstanding, that is your earnings per share. This must be shown in the income statement. So look at a company's 10K, look at the income statement, right below net income is earnings per share. And it's useful in comparing earning performance for the same company over time. It's not really useful comparing one company with another because of number of shares outstanding. Some people might use that, but it's good to compare it for the same company over several years at a time. And okay, next one then, price earnings ratio. This indicates how the stock is trading relative to the current earnings. So we just computed earnings per share. Now let's use that, divide into the stock price, and we get the price earnings ratio. This is also called the PE ratio. An average PE ratio is 15 to 20, and growth stocks will have a higher PE ratio. Look at these numbers. Facebook has a price earnings ratio of 32.2, a very high PE ratio. IBM, 13.4. Okay. Now, different people use these calculations to evaluate companies. Everyone has their own set of formulas they think are the best for them to use to evaluate companies, whether to buy the shares or not. But going back up here, look, on return on equity, IBM's doing much better than Facebook, much better. Facebook doesn't pay any dividends, no dividend yield. But the PE ratio is 32. Now the PE ratio up here indicates that the market has high hopes for the company's stock and has bid up the price. So these are growth stocks. People think the value is going to get even more and more in future years. So the higher the PE ratio, the more confidence investors have in that company that it's going to do a lot better in the future. Chapter highlights. So this is the end of the chapter. So quite a bit of detail here when you're talking about stocks and dividends and so forth. So read the chapter yourself, and good luck with the studies.